And we are going to begin, of course, with the markets. Stocks coming off their worst day of the year after the Dow posted its sixth largest point drop ever. But back in the green this morning with names like Apple and Boeing leading major indices higher. So what should investors make of yesterday's dive, today's rebound? Joining us now to discuss is UBS Global Equity Strategist Keith Parker and Cantor Fitzgerald Global Chief Market Strategist Peter Cecchini. Guys, good morning. Peter, you still think the S&P could drop a lot further from here? 12.5% by my calculation. You've got 2,500 target on the S&P for year end. If not yesterday, what takes us there?
Well, you know, to put it in context, end of last year, I thought we were well oversold. Recession fears were overdone at the end of the year. Our narrative has been a tale of two halves, rally first half, sell off second half. Why? China trade and the optics around it were a big reason for the rally in the first half, alongside the Fed pivot towards a more dovish stance. I think the Fed, short of new QE into the end of the year, has limited ammunition to prevent what I think is a normal cycle slowdown. And I think the optics certainly around trade with China have deteriorated. And frankly, the reason why the yuan above 7 is so important is it shows that trade wars become currency wars if they're prolonged. And trade wars, by the way, are neither good nor are they easy to win.
Now, Keith, you seem to think that the next round of tariffs actually is going to have less of an impact, if I read you correctly, than the first round did, though small business has been struggling. Is that a different read than we just heard from Peter?
I think this next round, what we had written is that the step up in May to the 25% tariffs on the original $200 billion, we found would have less of an impact than the original 10%. Why? Because firms reacted so quickly, and the initial tariffs were so disruptive. And so we saw the hit to growth materialize quicker and larger than we had originally estimated. And I think the risk here is if we do see those 10% tariffs on the remaining $300 billion go into effect September 1st, the growth hit would manifest later in the year, and in particular in the first quarter of next year. Why? Because the tranche is a majority of consumer goods, which would affect retail, and obviously that's key around holiday season.
Peter, I want to go back to a comment you just made that you sort of see this as normal cycle slowdown. Why? And what does that mean in terms of how trade war fears and tariffs, et cetera, are playing into the data?
Well, I think yesterday's move is really emblematic of how fragile the situation to some extent already was from a valuation standpoint, with the S&P well above 19 times earnings, and with really what's been a burgeoning slowdown since early this year. PMIs in developed nations are all in contraction at this point, except for the U.S. And even services PMI, or ISM, pardon me, has started to roll over and missed in its most recent read. Moreover, lending standards are starting to tighten, and we're no longer in an easy cycle for the Federal Reserve, albeit it did just cut. That's actually typical of a late cycle slowdown, where the Fed cut several times on the heels of a number of hikes, and a slowdown follows soon thereafter. That's typical.
And you also think that there's a lot of room for yields to fall further as well?
I do. Unfortunately, and when you look at global yields, long yields have been anchoring globally. JGBs and bunds have been anchoring U.S. yields for some time. And I think yields globally are really tending towards the new neutral, which is close to zero.
So, Keith, given what we saw yesterday with the market's reaction to currency, and then, you know, what we saw this morning, again, with the reaction to things not being quite as bad, what's your read on the dangers, particularly from here as we head through the month of August?
Yeah, I think that the read yesterday was, to me, the dominoes falling so quickly as it related to U.S.-China trade tensions, where the retaliation was quick and sizable, with the currency moving pretty significantly on the back of that. And I think today, some reassurances from markets that the renminbi around 7 is being held, at least for the time being. Always a risk around that. And I think the knock-on effects of dollar strength, when you see that reducing the purchasing power of 80+% of the rest of the world in dollar terms, is a big risk. And we saw that play out in 2015 and 16, and something I think the market is very concerned about. But again, I think the read-through yesterday yesterday was just how quickly things had escalated.
Yeah, very quick. Keith and Peter, stay close. We're going to need your continued help on stuff like this.